Well, it's a pleasure to be with everyone today. Very excited to have this discussion about funding early stage ventures. There's so many different ways to do it and so much information that is helpful so that it's done in the right way and you can maximize your efforts and your opportunity. So we're going to get started right away. So the first thing, and I know that of the RevRoad companies, most of this has been settled ground, but for those of you who may not have determined cap tables, this is one of the most important things in an early stage company, and it can actually trip you up as you go to raise capital down the road, so you got to get it right. So you could either be an S corporation, a sole proprietor, which would mean that you would probably not be seeking funding. So if you're seeking funding from institutional investors or even angel investors, an S corporation may not be the right venue for you, but it's an option. LLCs are obviously very popular. They're great because you have the opportunity to be able to write off losses in early stage companies. It's one of the things that we investors often like is that if there is an opportunity to write off some of your investment in the early stage as you're losing money, but you retain your place on the cap table, that can be an interesting place. But again, it's not going to be the place where you're going to live if you're going to raise institutional money. B corporations are becoming more popular as the world thinks about giving back. And it just depends on what type of corporation you are as to whether what you want to do as to whether or not this is right for you. And of course, we often talk about C corporations for investor-based companies. Delaware Cs are really popular because the Delaware law has been grounded and settled for hundreds of years. And so investors have a clear path of what it means. And so that's why they're comfortable with that C corporation. And that's a corporation that allows you to retain earnings as opposed to distribute your capital like an LLC or your earnings like an LLC. So founder stock, this is one of the interesting things about starting a company is getting your founder cap table, your early cap table correct. And there's really, and I'm not going to teach a whole session on cap tables today, but I'm telling you that it's an important part of your ability to go raise capital because I've seen companies where they had as many as 492 angel investors. That is a train wreck. That is, you know, legal, just like danger. You can only have so many. I think if you're over 500, you have to be a public corporation. And this corporation that had 492, it proved to be their undoing. So you really want to make sure that you protect your cap table and how you divvy out founder stock. So many times what will happen is individuals will start a company together and then one or two of the original founders will leave and they will try to take that founder stock with them. And when they do that, that's a huge challenge for the people remaining behind who are going to build the company to get invested. You know, number one, that early work that they did was probably worth almost zero. I know that sounds harsh, but it's true. The value is only created as sales begin to take place in significant levels. And so that's where the value is created. The people who create that value are the people who deserve to have the stock and who investors want them to have that stock. You don't want to leave behind these legacy situations. So having 4-year options or whatever, you know, 2 or 3 or 4-year options where they vest, and that could be true of even the CEO. In fact, if you get funded, many times they will put a percentage of your stock ownership, they will put that as needing to vest. They'll take it back, they'll claw it back from you because they want to make sure that you're not just going to up and leave. Restricted stock is a great way to, in many ways it's better than stock options for early plans and early founders and early key players in the company. Don't have time to talk more about that. And then the option pool. So you want to get the right cap table, and you want to get started right. This cap table is more important than you have any idea. You want to protect it. You want to get it done right. You want to learn about it. So I've got this book here so that you can learn some more about it. So don't get this part of company building wrong. So the very first thing that has to happen really to fund your company is sales. And people who are looking for outside funding before they have sales, it's really a difficult journey. So I always say, listen, you want to build a company, go sell something. And if you can't sell it, then how will you be able to raise capital to be able to, from people who are going to give up hard-won and earned money for something that has so much risk still. So I always say consider bootstrapping first for the first while, as long as you possibly can. And then you want to make sure along the way that early product development is the key thing that you're focused on. You have to deliver on your customer promise. And if your product isn't delivering that value and that customer promise, you have nothing to sell. So it's incredibly important that this become the focal point of your early stage company. And then you want to make sure that you have the right early channel, the right early adopters, the right terms, and the right contract. So we'll talk about this for just a second. There are many customer segments and there are many customer channels. In other words, our path to get to that customer segment. And we have to understand those. We have to understand them by testing, because there could be 4 or 5 different ways or sequences in which we could take our company to market. So we have to take the time to understand what are all those early options, and by testing, understand what is the first place to go, who are likely to be our early adopters, what are the terms that we're offering to those early customers, what do our contracts look like. Not enough attention is given in early stage companies to what their contracts with customers look like, the terms of those contracts, all of those things in order to bootstrap a company and to begin with sales have to be put in place. So we've talked about in the sales jargon, developing and fine-tuning your value propositions. Your ability, as we say, to say, John, this is what you're getting today, but what if tomorrow, instead of doing this, you were able to do this? Now, the advantage of doing this over this is this, and the economic benefit is this. It's the early FAB model of sales, feature, advantage, and benefit. And it allows you in the early stage to think about how you present your company and to make sure that you understand the return on investment, the ROI, that your customers are going to get as a result of using you compared to the incumbents, those who are already owning the marketplace. This is really important. It's more important than people have really understanding in early stage companies, getting the value propositions right, understanding your use cases and which use cases are most valuable and how you separate yourself from the pack. Gaining strong customer knowledge from the very beginning, because when you have strong customer knowledge, you come across as a professional, you come across as a professional to your customers, you come across as a professional to investors, you gain confidence for the people that work with you in the organization. It's incredibly important that you have a strong customer knowledge and industry knowledge so that you can lead the field. Refining your sales presentations. This often, again, is a weakness of early stage companies. If you haven't gone through and understood the value propositions and understood the incumbents, understanding your positioning against those incumbents, then you'll probably not likely develop your sales presentation into a pitch that will resonate with these customers that you're trying to sell in the early stage. And then, of course, you have to understand the potential customer objections and to answer those in advance for yourself so that you don't get caught short when you're trying to sell somebody and they raise an objection, you don't have a good answer, you know, obviously you're not going to walk away with the sale. But if you have those, objections firmly understood and answers to them that are really powerful, then you have an opportunity to get past all of the early objections and into sales, and you can fund your company. So one of the first ways other than sales is crowdfunding. You can use Kickstarter, you can use Indiegogo, and there are others, but these are 2 ways that are well known today, particularly for product companies. Not the best way for technology, SaaS companies and so forth, but it is a way to fund some early stage companies. And then we always talk about friends, family, and fools. And this is because it's like, as we always say, it's like the singing one. Why is this not coming to my mind? Pardon? Yeah, I can't sing it. It's that famous one, not The Voice, but it's the American Idol. So think about, thank you. Think about American Idol, okay? Your parents think you could actually are maybe better than you are, so your parents say, or your friends even, you know, you should go do that because you've got this great voice. And it's sort of like the difference between, as we like to say, someone, you know, if you took someone with a close to a scratch golfer and compared them to a professional golfer, it's night and day, the difference. Honestly, the difference is night and day. Even though they're both very good golfers, one would not prevail. So in the friends, family, and fools, to actually get up there on stage and be worthy of a worldwide audience, you got to be prepared for prime time. And the same is true when you're trying to raise capital, because $50,000, I just want you to think about this, $50,000, $60,000 might be the average wage for a person for an entire year. And now you're asking people to give up hundreds of thousands of dollars for what? What do you have? You need to be ready for prime time. So I always like to say, surround yourself with credible mentors who will help you not to make mistakes in this early stage of fundraising, because you don't get second chances. You get up in front of somebody, if they reject you, almost surely you're not going to get a second chance. So you want to have credible mentors to help you. These are people that have climbed to the mountaintop. They can see on the other side, and you're still on that journey up. So you got to make sure that you've got good, credible mentors helping. Establishing the correct articles of incorporation and the operating agreements. Those things need to be put in place. You're going to put friends and family at risk. You need to have all these I's dotted and T's crossed. You want to still, even when you're raising money from friends and family and fools, you want to make sure that you're bootstrapping first and taking this as far as you possibly can. Don't ask people for money if you're not willing to sacrifice yourself. If you can't give up your own time for free, I think every company that I ever started, I worked for free for probably 2 years. And I put in my own money. And then I asked people for money, because they knew that I was all in, and that if they went down, I was going down, and not with a little bit. So I just think that it's really important for people to recognize the sacrifice that it is to start a company and have your own funding plan in place so that you're capable of bootstrapping for some period of time. I always like to try to get loans or convertible debt, because how do you value an early stage company? I've sold companies that had millions and millions of dollars of revenue for less money than I see some people raising at, and they've got nothing but, you know, some early traction and a good idea. So valuing companies is super hard, and today the valuations are going up, up, up. That's good for all of you entrepreneurs, and it's, you know, for the investors, not so good. But that's the way it is, and so I think that there's a way to keep equilibrium, where, you know, investors are trusting and they're believing in you, and then you need to be trustworthy and believable back. It's a team effort. You can't do it without them, and they can't create value without you. And so it's a team effort, and integrity and character, they matter most to me in these early thought processes around raising capital on both sides of the fence. Chase sales instead of money. So we go right back to my first slide, sales, sales, sales. Take as little as possible and then feel the stewardship to repay that investment. That's what happens when you take investment. I always used to feel, as a matter of fact, I'll tell you this story. In my on my second venture, I was raising capital, but first I had worked for 2 years and I put in about $700,000 of my own money. That's not a small amount of money, okay? And I worked for free for 2 years. So then, as we found out that the whole industry was going to take us time, because the industry wasn't going to adopt our first SaaS model until the whole industry went wireless. This is back in 2000. Wireless had just appeared on the scene, brand new. We had no idea how long it was going to take. It was going to take 3 years, 4 years, 5 years. As it turned out, it took 6 years. So we were 6 years to profitability. And during that time in raising capital, we ran out of money 5 times. I mean, that's some stress. So what was the stress? Was I worried about my own money, my $700,000? Sort of. But I was more worried about the people that I had invited to join me in the venture. And I was raising capital, it was called the Bi-State Investment Group. It was an angel group, Kansas, Missouri. I lived in Kansas City, so they called it the Bi-State Investment Group. And my partner, he said, "Scott, were you like nervous?" And I said, "Nervous? What are you talking about? I never get nervous in front of crowds. It's just not in my nature to get nervous." "No, Scott, you were shaking. I think you were nervous." And I said, no, I wasn't nervous a bit. Totally confident. "No, Scott, you were nervous. You were shaking." And I said, "What are you talking about?" "No, I'm not." And my hand was going like that, you know, and it's because I was freaked out, running out of money 5 times, that I might, you know, lose money for these people that I cared about and trusted. Obviously, I went to the doc to find out what it was. It was just my nerves, so I just worked out harder. All right, so the moral of this story is, please, if you're going to take money from somebody, then feel the ownership of repayment. Establish and maintain the investable cap table. This is up to you as the CEO of your company to make sure that you own that stewardship. All right, so then we run into super angels and angels. So there's 3 different things that we could probably look at here. We can look at equity versus convertible debt, because again, in an early stage company, how are we going to value this? How do you value somebody that has wireframes, where the CEO has incredible experience, industry experience, but they just have wireframes? They haven't built their product yet. They haven't assembled a team, and now they're looking for capital. We've actually funded one of those, and we think it's still going to do really well. We're sure of it, actually. I am. I feel very comfortable about it. But at the end of the day, how do you value that kind of an organization? It's tough. So sometimes we do convertible debt instruments, because that allows the investors to get a pretty decent interest rate, and also to get a discount on the raise of the Series A or a significant Series seed. So it can be a win for the investor, and it can also be a win for the company, because they're not having to price the round, you know, at some low valuation, give up a big percentage of the cap table, because the value hasn't been really established yet. So this is positive for entrepreneurs a lot, and can be positive for the early investors. Safe notes, I'll tell you, I don't like them. I don't like them at all. And I'll tell you why. because they're untested. You're neither a creditor nor an equity holder. And so you're not on the balance sheet. You have no rights. It's not been tested in court. I don't like them. I have a hard time investing in them. I have done it once or twice. It's not that it turns out bad all the time. It's what could happen. And as an investor, I'm always looking at the worst case scenario. And so I try not to get involved in those. But they're very popular. They were made popular by Y Combinator. But I think there are risks that everyone should be aware of. And then, of course, a priced round, which I think is really investor friendly. And depending on your stage of growth, can be unfriendly to the entrepreneur, which is why there are other options. We've talked a little bit about early stage valuations and the trickiness. There is actually, sort of market pricing that goes on. It's basically supply versus demand, right? And so what's happening today is there are so many wonderful entrepreneurs out there that are risking and doing great things that these valuations are going up. And I had a call from a large venture capital group just yesterday, and I sat on a call with them for about an hour, and we were counseling together about what could they do to separate themselves from the others, the other venture capital groups, because money was a commodity. There's so much money out there. It's because we're printing money. I can't even take time to talk about that. But it's a challenge. But it's the nature of where we're at today. And because there's so much money out there, there is really some big opportunities for entrepreneurs today. I always look when I'm seeking capital to have great fit with the founders. I use that silence so I could let that sink in. There needs to be a good fit with the founders. Founders should look not just for money, they should look for smart money. They should look for money that creates alignment. That's not always possible, but if it is possible, then you should definitely do that. And I can remember one time selling one of my companies to a private equity group, and we had 8 offers. And so then it was all about fit. It was all about who do we fit with best as a management team? Who do we trust that it's going to be the best experience? And even then, it's still, up in the air. You don't know how it's going to go. But you're looking for that fit. Whoops. And obviously then, if you're going to be pitching to angels and super angels, you want to have a professional presentation, a pitch deck that your mentors would be proud of, not your mothers, but your mentors. All right, so what is this professional presentation? I did a video on this here at RevRoad. All of you would have access to it. Still quick, it's still brief. It doesn't fill in all the holes, but it does give a little bit of color to what a presentation might look like. I like to do it in this order, and I'm going to tell you briefly why. An intro allows somebody to know exactly what you're going to be talking about. In other words, in a presentation, tell them what you're going to tell them. Then you tell them, and then you tell them what you told them, right? You've learned that your whole life. I like to frame the problem or pain in such a way that it's so powerful that they can feel it, that they feel that pain so powerfully that they're willing to lay down the money. I actually say, this is such a big problem. Surely there are people out there trying to solve it. And yes, you'd be right. There are plenty. Here they are. And I talk about them in my story form. Here they are. But the problem is, they're not solving the problem that we've just framed up here. That's why I like it in that order. And then we talk about the solution. Again, since we're not doing this as the topic today, it needs to be a very carefully articulated, people make presentations today. They've been in an industry for years. They understand it. And they are pitching to people, even investors, who really know not that much about it. And expecting, when they use terms and so forth, that they understand it and it's going right over their head. And so you've got to be very careful to frame it simply, powerfully. What's the validation of your solution? What's the traction? What is your go-to-market? People want to understand that you know how you're going to take this company to market, that you know the marketplace, you know the customer segments, you know the channels, you know the early adopters. You have a plan to take this out to the marketplace. And then validated financial projections, not just this, whoop, you know, right up here. So on one of the, it's not that they're not going to look like that. Frankly, they probably are. But we all know that it's the emperor with no clothes. So the thing about these validated financial projections, when I showed supply pattern, I said, here's 200,000 dentists, 200,000. And if we get 100 of those, and we already have 30, then we're going to be way past break even. 100. Do you think an investor can see their way clear to that we can get 100? Yeah, they can. And in the second year, with some money and a team, a bigger team, we can get to 400 customers. That's only 300 more. There's 200,000 of these. Is that realistic? And they'll say, yeah, I think so. Anyway, so by year 5, we're showing 4,000, 2% of the marketplace. Anyway, it's believable. So you have to validate these financial projections. All of your inputs, your assumptions need to be validated. And then who is the team that's going to deliver on this promise? That's the biggest of all. And then you're going to ask for some money. So the Series Seed round, ensure that you've got this solid team formation with a credible CEO. They're going to rest their case on this credible CEO. You better be that credible CEO. A solid cap table without any material problems. They're going to be looking for that. The correct founding documents, which is why you need to anticipate what kind of company you're going to be. Are you going to be an S corporation or an LLC or a B or a C? Product market fit established. So when you're raising $1 million, we'll say, you know, they want to see that you're not just an idea on a napkin. You've got to make sure that you have these customers, which is why we start with sales, 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 sales. And then when you have proven that that the customers want what you have, in other words, that the customers are going to eat the dog food, then great. You'll be in a good spot to go raise capital. A refined presentation. You're going to find that your presentation is iterative. The presentation that you have today, that you work for the angels, is not going to be the one that you're going to present to the seed company. And the one that you presented to the seed company is not the one that you're going to present to the Series A. There's going to be a progression that needs to take place there. And then, since we've talked about sales so much as being an important part of funding, you got to have a front office sales system that everybody appreciates, that all the investors, when they look at, they're going to say, wow, that's pretty good. So we have a marketing operations program where we're getting these qualified leads. So we have developed and we're executing on marketing campaigns, and we're measuring by the type of quality leads that we're getting. So then we're not just depending upon people going out and cold calling and catching people at the beginning of the buyer's journey. We actually have a lead gen machine that's begun, and we're getting leads in the door, and we can show conversion on these leads, and that's an important piece. We need to make sure that the sales development reps have, that's a solid part of your company. So you've got not only this inbound lead gen machine, but you've got this outbound lead development machine that's also going strong. And then you've got new business account execs, people that are quota carrying, new business sales representatives, development. And so what are their responsibilities, and how are they being measured, and are they producing? And when you present and pitch to investors are you able to demonstrate these things that we're talking about right here. And then finally, the customer success. You got to make sure, because these people that are funding your efforts, they want to make sure that you're not going to have churn. They want to make sure that you know how to take care of these existing customers. They want to make sure that when you sign up a customer that you're brick building and you're just going to start stacking bricks. Customers that keep coming in the door and nobody going out the door. You got to make sure you don't have a sieve here at the bottom. Leaky sieves are a problem with companies. And the way you stop that is by having a fantastic client success team. So the front office has to be in a big place. So then with the Series A, we have to further refine product market fit because we're going after a bigger check. And you know, the biggest problem with a bigger check is that you probably don't yet know how to spend it. It's a problem. And most of the venture firms don't help you to learn how to spend it. In fact, they may be motivating you to spend it too quickly before you've really found product market fit. All right, and then you got to nail and focus on a single execution strategy. You can't be splintered. You can have all these different opportunities that surround you. You could do 50 things, but you need to start with one thing and go deep. That's what they're going to be looking for. And then you got to solidify and restructure, if necessary, the executive team. When you raise $5 or $10 million, you got to make sure that you've got a full team to execute. And that's why the founding team has to continue to grow. And if that founding team doesn't continue to grow, then somebody who is on that founding team may have to step down so that they can bring somebody in who has the experience to take the company to the next level. You can't be holding out for pride. You have to remember that the most important entity is the company itself. And you have to have enough humility to make sure that you're sitting, that you've got the right people in the right seats on the right bus. So we have to prove that we're able to execute on the sales models and the revenue projections. We can show them that here's been our past forecasts, and here's our forecast of the future. Past performance is almost a perfect indicator of future performance. We build out systems and repeatable best practices. When you're raising a Series A, I'm telling you, they want to see that you're not flying by the seat of your pants. If you actually repeat something, a process, then you need to reverse engineer it and document it, and it becomes the Bible of your company. Only the difference is it changes with learnings. So you're going to, as you learn, improve your best practices, and that'll be the new best practice. So it's fluid. And then you're going to have higher sales growth, which means higher valuation. So you want to look at the steepness of your curve. And if you can get your sales curve doing this, that's what they're going to be looking at, and then that's going to determine the valuation that you get. So you want a big valuation? Increase the curve. And then update and refine your pitch deck. And finally, the rule of smart money still applies, and build lean. There's a great book called Scaling Lean. So I hope that you'll think about, you just don't start lean in the beginning, but you remain lean going through the process. I'm not going to spend too much time here, but Series B, C, and D rounds, they are meant for companies that are high growth and they need that money for growth, and that's all they need it for, because everything else has been proven out on the business model. So churn rates are everything. Private equity options, that's an option, and I've used this option before, where you've got tens of millions of dollars of revenue and you don't need money, and so private equity groups will come in and do a recap Maybe they'll pay you 70% of the value of the company. You'll retain 30%, have an opportunity for a second bite at the apple, and so forth. And then there's mezzanine options. This usually happens in private equity, so I'm not going to talk very much about this either. But it's where, you know, in a financing when your company gets bought out, then there'll be bank debt, there will be mezzanine usually, and then there will be the equity that the investment group puts in, and so there are those options. Anyway, it has been great to be with you today. Raising capital can be a fun and wonderful journey if you're prepared for it. So my hope is that you will really do just that and become experts in learning how to raise capital the right way. Thank you very much.